we'll discuss share-based payment Index 102. Uh, Financial reporting by an entity which undertakes share-based payment transactions. Entity, goods or services from employee or non-employee. Share-based payment arrangement and transactions. Entity and other party is a supplier or an employee, which entitles the other party to receive cash settled, to receive other assets based on value of the equity shares, cash settled, to receive equity instruments, equity settled, 1,000 options to complete 3 years of service. 3 years of service will be the vesting conditions, and it will be equity settled. If cash equivalent to 10 shares are paid, then it is cash settled. Then it is cash settled. Share appreciation rights entitlement of cash is dependent on increase in share price. Share appreciation rights uh, is given 100 share appreciation rights at rupees 10. Price increased by to rupees 12. Then 100 to 2 is 200 is the cash settled liability for equity shares. Share-based payment transaction is a transaction in which the entity receives the goods or services from the supplier, employee or non-employee in a share-based payment arrangement. Liability is settled by shares of group entity is also share-based transactions. Scope of India's 102. Uh, all share-based payment transactions, equity settled or cash settled, share-based payment transaction with cash alternatives, either by way of equity or cash, grant to employees or directors are also covered. Grants to suppliers, goods will include inventories, consumables, PPE, intangible assets, and other non-financial assets. Employer share purchase plan, percentage of salary contributed they can buy at a discount or and also share-based payment. Share-based payment plans are settled by group entity. Also share-based payment plan. Types of share-based payment: equity settled, like share options or warrants; cash settled, like share appreciation rights; share-based payment with cash alternatives settled by equity or cash or other assets. Accounting requirement differs for each type of category and whether it is employee or non-employee. Employee measurement is different. Non-employees measurement is different. Recognition employees is same. Non-employees is same. Timeline of share-based payment award, grant date. If you're employed for 3 years, you are entitled to 1,000 shares to be exercised in 2 years. All three to be exercised in 3 years would be the grant date. Vesting period would be 3 years time from the date of grant. This will be the vesting date, and exercise date when the rights are exercised would be the exercise date. Total life of a share-based payment arrangement is grant date plus vesting date plus exercise date. Grant date uh, grant date agree to have a common understanding of the share-based arrangement. It is the grant date when the award is to be fair valued. If the agreement is subject to approval by the shareholders, then grant date would be the date of approval by the shareholders. ESOP are given and accept the same on the portal. Then acceptance on the portal is the date of grant. Recognition principle for share-based payment. When goods are received or services are received, how to recognize in equity shares if equity settled, in liability if it is cash settled, employee benefit expense to equity settled, to liability cash settled, equity account debit to equity share capital on issue of shares, liability account debit to bank account on payment of cash. Liability is remeasured at each reporting date. Share appreciation rights 10, 12, and 15 in the year 3, 15. So 200 would be the liability increase in liability in year 1, and 300 would be the increase in liability in year 3. What point in time or over a period of time recognize the expense, record the expense in the year. If it is for uh, 1,000 into 9,000 is at the end of 3 years, then recognize 3,000 in year 1, 3,000 conditions are satisfied, it is recorded over the vesting period. If it is a past service award, then recognized at a point in time, 1000 into 9000 in year 0 as to be recognized. So employee share purchase plan is at a discounted price, and employee share options is at the market price. Measurement principle: equity settled. Employer fair value of equity instruments at the grant date. If it is not available, then intrinsic value. Non-employee measurement fair value of goods or services received, not the fair value of equity instruments. If the fair value of goods or services is not available, then fair value of equity instruments should be used. Cash settled is share appreciation rights. Fair value of liability at each reporting date. Who is the counterparty? Employees. Measurement date basis would be fair value of equity instruments. Initial measurement date would be grant date. Recognition date would be the date when services are received. For non-employees, fair value of goods or services, or if the fair value of goods or services is not there, then fair value of equity instruments. Date of receipt of goods or services would be the measurement date, and date of receipt of goods and services would be the recognition date. Vesting and non-vesting conditions. Vesting conditions are service conditions or performance conditions. When service conditions or performance conditions is there, then there would be true up, true down in the on the failure to satisfy conditions. And if service condition and non-market conditions are there, that is SN, then it will be reflected on the grant date. It will not be reflected on the grant date fair value. If there would be, if SN is there, then there would be true up, true down for failure to satisfy conditions. In any other case other than service condition and non-market conditions is there, then it is reflected in grant date fair value, and there is no true up, true down for failure to satisfy conditions. Purchase of goods. Assume XBRL has 995 shares in exchange of purchase of an office building. The title was transferred in the name of the entity on 2011. The shares were issued on the same day. Fair value of the building is 2 lakh. Face value of the shares is 100. Given the above criteria is met, uh, recognize the share based transaction. So PPE account debit 2 lakh, to equity share capital 99,500, to share premium 1 lakh 500. Example, if there's a maintenance company which provides service for 3 months period, the consideration is settled 1,000 shares at the end of month 3. The fair value of the services is 1 lakh rupees. Nominal value of shares is 10 per equity share. Then equity account debit 1 lakh, to equity share capital 10,000, to share premium 90,000, and for repair and maintenance account debit to equity account 33,333 would be the charge in year month 1, month 2, and month 3. Uh, equity settled, total 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 value of at the grant date would be total number of options into grant date fair value into percentage of options expected to vest. Management as assumption can affect the results. Grant date. Uh, Grant date, number of employees 500, year 1 500, year 2 500, and year 3 500. Number of options is 100. Expected employee turnover is 15%, 15% in year 1, 12% in year 2, and year 3 and A. Actual number of employees left is 20 in year 1, 22 in year 2, and 15 in year 3. Fair value of each option is 15, 15, 15. So SBP charge for the period would be near 1 500 into 100 into 100 minus 15, that is 85%, into $15 into one third would be the cumulative charge for year 1. In year two, 500 into 100 into 88%, uh, into two-third would be the charge for the year two. In the year three, the computation would change and actual number of employees exited would be considered. So 500 minus 20 minus 22 minus 15, that is 483 into uh, 100 into 15 into 100% would be the charge for the year 3. So the charge for year 1, cumulative charge would be 500 into 100 into 15 into 85% into one third, that is 212500, and expense for the year would be 212500. In the year 2, 500 into 100 into 15 into 88% into two third would be the cumulative charge, that is 4,40,000, and charge for the year would be 4,40,000 minus 212500, that is 227,500. In year 3, 443 into 100 into 15, that is 664 500. 664 500 minus 4,40,000 would be the 224 500 would be the expense for the year. Uh, uh, cash 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 settled cash settled with employees, remeasure the liability at each reporting date, share appreciation rights, example 10, 12, 15, 200 in year 2 and 300 in year 3 would be recognized. Total value at the grant date, total number of share appreciation rights, fair value of share appreciation rights, percentage of share appreciation rights to vest. Example, grant date 500, uh, uh, year 1 500, 500, year 3 500. Number of cash settled award is 100, 100, 100, and 100. Number of employees already left is 35, 75, 97. Number of employees expected to leave is 60, 25 NA. So 500 minus 35 minus 60 uh, uh, would be the number of employees 405. 500 minus 75 minus 25, 400 would be the charge, uh, would be the number of employees per year 2. 500 minus 97, 403 would be the number of employees per year 3. 14.40, 15.50, and 18.20 would be the uh, chart, fair value. 405 into 100 into 14.50 into one third, 400 into 15.5 into two third, 403 into 18.20 into 100% would be the charge for the 3 year. 194 400 would be the cumulative charge, 218933 would be the cumulative charge, and 733 400 would be the cumulative charge. Charge for the year would be 41 uh, 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 413 minus 194 400, 733 400 minus 2 413 300 would be the charge for the year. Share-based payment with cash alternatives. And when employer has a settlement choice, you need to assess the intent of the entity to settle in cash or in equity. If the entity has a past history of settling in equity shares, then it will be equity settled. If the entity has a past history of settling in cash, it will be cash settled. If the counterparty has a uh, counterparty has a settlement choice, then it will be a compound financial instrument. Compound financial instrument is an instrument wherein equity and liability is there. So fair value of instrument minus liability would be the equity amount. So if the fair value of liability is 4,50,000, fair value of PPE is 5 lakh, the equity would be 50,000. So liability account debit 4,50,000, equity account debit 550,000 to equity share capital 5 lakh. Equity settled graded vesting. In case of graded vesting, there would be front loading of expenses. So 6,000 is a charge for year one. So 6,000 entire would be charged in year one. 6,000 is charged for year two. Then 3,000 in year one and 3,000 in year two would be charged. 6,000 is a charge for year three. Then 2,000 in year one, 2,000 in year two, and 2,000 in year three would be the charge for the year one, two, and three. The total charge would be 11,000 for year one, 5,000 for year two, and 2,000 for year three. This is front loading of expenses. Grant Example of graded vesting. Number of stocks 3,000, 3,000, 3,000. Service condition 3 years. Vesting conditions one third, one third, one third, one third. Graded vesting. It is graded vesting. Number of options is 1,000 and fair value of the grant date is 10 each. So 1,000 into 10, 10,000 would be the charge in year 1, 10,000, 5,000 and 5,000 in year 1 and year 2. Uh, and in year 3, 3,333, 3,333 and 3,333 would be the charge in year 1, 2 and 3. Modification of share-based payment. If the modification decreases the fair value of equity instrument, then original grant date fair value would be there, and such modification to be ignored. If modification increases the fair value of equity instrument, then original fair value plus incremental fair value would be the modification charge. Cancellation or settlement of share-based payment upon. Uh, in case of cancellation, there would be accelerated vesting. That is, the entire amount to be charged in future years would be charged in the year of cancellation. Entity has granted 5 years share option, and the grant date is 10. The grant amount is 10 million, and the same is to be granted after 5 years of service. But in year one and two, 2 million and 2 million are recognized, and in year three there is cancellation of grant. How would it be dealt in as per Ind AS 102? In year one, 2 would be charged. In year two, 2 would be charged. The total value is 10. 10 minus 4, 6 would be charged in year 3, which is cancellation charge, which leads to postponement of expense. So entire 6 would be charged. Uh, if there is a preponement of expense or settlement of SPP awards, then there would be preponement charge. Example, number of directors are 10, number of shares options is 2,000, vesting period is 3 years, fair value of share options is 130, expected employee number of directors to exercise the share options is 8. In year 2, the entity had a crisis and it cancelled the scheme. Fair value of options is 90, number of directors and employment is 9, and compensation paid to directors is 95. So, number of directors 10, number of shares options is 2,000, service condition is 3 years, fair value at the date of grant date is 130, expected number of directors that are expected to vest is 8, 2,000 into 130 into 8 into 1/3 69333 would be the year one charge, 2,000 into 9 into 130 2340 would be the charge for year 2 consolidated charge minus 69333, that is 164667 would be preponed, and cancellation compensation is 2000 into 2000 into 9 into 95, that is 17 lakh 10,000, and fair value of cancellation compensation is 2000 into 9 into 90 16.20. So 17.10 minus 16.20, 90 additional 90 would be charged in the year 2. That is, the charge in the year 2 would be 164667 plus 90,000 would be the total charge to be in year 2. Group uh, charge arrangements, selling entities, settling entities, parent, receiving entity is subsidiary, then subsidiary would record employee benefit expense to capital contribution from parent, and parent entity would record investment and subsidiary to equity. If it is settled by subsidiary, then it will be considered as cash settled. This brings us to the end of the session. Please do like, subscribe the channel. Thank you so much.